Hi, Dr. Dolly. I have a question about buffered ETFs. So I'm currently saving 3 years worth of expenses in case I choose to do an early retirement at age 57, which is 2 years from now. I am eligible for a sizable lump sum or pension at age 60, which is why I want the 3 years. I already have most of the money saved in a high yield online bank and a mixture of short and intermediate term bonds. However, with the yields being so low, I hate the idea of my money sitting there losing steady ground to inflation. What do you think about buffered ETFs as a solution for this specific problem? Thanks for your podcast. It has helped me tremendously.
All right, buffered ETFs. What's a buffered ETF? Well, they're generally linked to the S&P 500 index, and then they provide some sort of downside protection. So these sorts of products are really common. They're common in the insurance space in particular. We're talking about annuities, index-linked annuities. We're talking about index-linked universal life policies. And the basic theory is the same with all of them. The idea is to have your cake and eat it too. And, so they're really attractive because this is what we all want, right? We want high inflation-beating returns, but we don't want to take any more risk than actually putting our money into a savings account. And the truth of the matter is you can't get it. It doesn't exist, okay? The higher the returns you want, the more risk you've got to take. You want to beat inflation, you got to have money in things that beat inflation. And for the most part, that means, stocks, real estate, those sorts of risky assets that can go down in value. So you have to ask yourself, for a given goal, what's more important? The return on your principal or the return of your principal? And when we start getting into time periods like 1, 2, 3 years, the return of your principal starts mattering more than the return on your principal. That doesn't mean you can't take any risk at all, but it maybe means you don't want to have it all in risky assets. So you've got to decide how much risk to take, and maybe that's a balanced fund that's mostly bonds. Maybe that is, a balanced fund that's mostly stocks. You got to ask yourself, well, what are the consequences of loss, and when do I really need the money? How definite is that date? And that's kind of the trick with short-term investing. For example, if I've got to make a tax payment, I got to make an estimated tax payment in 4 months. I'm not taking any risk with that. That's going to sit in my high yield savings account until that tax bill is due. It might even sit in my checking account just because I don't care so much about the return on the money as the return of the money. But if you're saving for a house down payment in 3 or 4 years, maybe 5 years, you don't really know when it's going to happen. Well, you can probably put some of that into equities, real estate, et cetera. Make sure it's liquid enough for your needs, but you can take some risk, especially if the value of those assets goes down isn't a big deal. But the problem is these people selling products, whether it's buffered ETFs or annuities or universal life policies, they're trying to cash in on that desire of yours to have a higher return without taking higher risk. And for the most part, you're paying too much for the benefit you're getting. You're taking on more risk and you're not being appropriately rewarded for doing so. Or you're simply just giving up too much of the return to limit your risk. So I'm not a big fan of these sort of structured kind of investments. I think you're better off with plain vanilla investments where you can see exactly how much risk you're taking. And if you want to take some risk, that's fine, add a little risk in, but I don't think you need to go to these sorts of products. And when you look at the names of the companies that are putting these things out, it's not necessarily companies you would normally go to invest, So keep that in mind. I would, as a general rule, avoid these buffered ETFs. I think they're a product made to be sold, not bought. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.